Today, we're clearing up one of the biggest sources of confusion for investors: the difference between arithmetic returns, geometric returns, time weighted returns, and IRR, or internal rate of return. Each one tells a different story, each one answers a different question, and most investors don't realize how important these distinctions are. By the end of this video, you'll understand how to properly judge your personal performance, your portfolio manager's performance, your investment's true growth, and why advertisements sometimes feel misleading. Let's dive in. When I was head of investments for a university, I got all sorts of materials from funds that claimed they were number one in their space, which was strange because they all couldn't be number one, right? And they would show all sorts of numbers that, to average people in the street, well, this could be very confusing and difficult to understand. So in this video, we will address the potential confusion that could arise by discussing returns from a practical, intuitive approach. Now let's start our discussions with the arithmetic return. Suppose you hired an investment manager who doubles your money in his first year due to superior investing strategies, but cuts it by half in the second year because of poor markets. Now we prepared a quick table here detailing the returns. So the first year, there's a return of 100%, and the second year, it's a drop of 50% for an average of 25%. Now, can the investment manager now say you've earned 25% because the arithmetic average is 25%? Clearly, if you started with 100 and ended with 100, how could you have earned 25%? It's clear that you didn't earn anything by the end of the investment period, so 25% does not make sense. So what does the AR, or arithmetic return, of 25% actually mean? Is this therefore the fund manager's investment performance? How good was he managing your funds? But then again, did he actually make 25% performance gain when the funds earned nothing in the end? So clearly, just like in your personal case, his investment performance is not 25% either. So again, what does that 25% return actually mean? Well, that's a mathematical expectation, a statement of possible returns in the future. It could be 100% or it could be minus 50%, and it will average 25% if you play the investment game long enough, but with a lot of uncertainty as measured by your standard deviation. If you want to review these concepts, do please visit our crash course on statistics for discussions about returns and standard deviations. It's not a useless metric, and the fact that we can narrate what happened tells us how useful arithmetic returns are. It's just that it's not a measure of your true investment performance. So the question remains, what should be therefore the measure of fund performance? Obviously, if you started with 100 and ended with 100, your return should be something that reflects that fact. Now observe this phenomenon. If the fund went from 100 to 200, then back to 100, then the returns could be presented as follows. 1 plus R is equal to value now all over value previous. It's like price now where price previous is your return. Now notice we can write this down as 1 plus R1 times 1 plus R2, which is equal to 200 over 100 times 100 over 200. In fact, we can extend this, and no matter what happens in between, only the ending value and the beginning value are important because all the intermediate values cancel out. Please see below. This suggests that it's the product of all the 1 plus R's which should be emphasized rather than arithmetic returns. Therefore, we're going to have this. Of course, we can compute for the particular R's if we wanted to, and please check the spreadsheet for sharing to see those R's in the video description below. But in general, we just need to generalize the formula for now using the product operator. So I'll just call it 1 plus the horizon return is equal to 1 plus R1 times 1 plus R2 times 1 plus R3 and so on and so forth. Or the product operator of 1 plus R, and the horizon return would be the product operator of 1 plus R minus 1. Of course, if these were annual returns, then we need to get the nth root of all the annual returns before subtracting 1. And in finance, this is the geometric return GR. So 1 plus GR in this case would be the fifth root of all the 1 plus R's. Therefore, your geometric return is the nth root of product of the 1 plus R's minus 1. Now, it looks complicated, but it's actually quite simple. For our problem, the geometric return is 200 over 100 times 100 over 200. And that's just the square root of that minus 1. So, which gives us 1 minus 1 equals 0. And this gives us precisely 0, the annual return we earned over the 2 years. This is the fund performance as measured by geometric return in a nutshell. Therefore, the geometric return is really the return used in practice to measure historical returns, while the arithmetic return is used to estimate future returns. Now, going back to our case, the fund manager should show the geometric return of the fund to you if he wants to showcase his historical performance rather than showing the arithmetic return. Let's add more realism to the situation. Let's backtrack a bit and supposing you that after seeing that your fund manager doubled your money after 1 year, you added an additional 100. So now your money is 300, the 200 that you put in, and the 100 that your money earned. However, the fund gets cut in half as we already know from the story in the second year. We already know that the return performance should still be 0 because the return situation has not changed at all. It's still 200% and negative 50% respectively. Now think about that for a while and let that sink in. Meantime, the only thing that changed here is that the client topped up by 100 after 1 year. However, from the client's point of view, the invested money was 200 and the fund is now only 150, meaning it's not 0 anymore, but a loss of 50. Clearly, even if you might agree that the fund manager performance is still the same, there has to be a way to reflect the client loss, right? Well, yes, there is, and the answer to that is to use IRR, or the internal rate of return. For IRR, remember that we measure the cash flows. At time 0, there is a cash out of 100, so we write negative 100. At the end of year 1, there's another cash out of 100, so we write down negative 100 again. And then at the end of year 2, the fund of 150 is returned, so we write positive 150. Notice that the 200 ending value of the fund at time 1 is not considered because it's not a cash event. Now, using Excel to compute for IRR, we have an IRR of negative 17.7%. This is the return of the investor for the given 2 years. And to double check that amount, let's verify this. So the ending amount at year 1 is 100 times 1 minus 17.7% is equal to 89.29. It gets topped up by 100 by that time. So the beginning value becomes 182.29. Now, it's going to earn negative 17.7% at year 2, so that 182.29 becomes 150. So, it captures perfectly the return of negative 17.7%. That's the loss of the investor. Now, there are 2 things we should notice here. Number 1, IRR is in fact an effective annual return as it gives the effective annual compounding rate that produces the desired cash flows. In finance and in investments, it's called the dollar-weighted return or the money-weighted return. Number 2, this is rightly considered the investor's return. And it's affected by what the investor does independently of what the fund manager does. Now, an outsider who doesn't see the cash deposits or withdrawals might see only the fund and might come to the conclusion that there is a positive geometric return. If we compute the geometric return, we're going to get 22.47 as follows if we treated the fund with the deposits and withdrawals, if there were. You, however, know that deposits happen in between, so this is clearly incorrect, as it was a deposit that ballooned the fund and not investment income. So doing the analysis this way means investment return is attributed to what is really a fund infusion. So to avoid this problem, we had to take out all investors' cash flow movements, whether inwards or outwards, before we compute the geometric return. Essentially, we have to chain link the returns, netting out all such investor activity as follows. For example, in year 1, it's going to be 200 over 100 is equal to 100%, meaning take the ending value before the 100 deposit, so it shouldn't be 300. However, by year 2, it's going to be the ending value is 150, but the starting value will not reflect the 200, but the new fund, including the 100 deposit. It's going to be 150 over 300 equal to negative 50%. Meaning this time we consider the whole 300 as the starting value that was exposed for the whole year and which yielded 150. So the geometric return is shown below and it's the same as previously depicted. So note that after netting out the investor cash flow movements, we've captured the original geometric return, a big fat zero as before. Now, this is known as the time-weighted geometric return, aka the time-weighted rate of return, or TWRR, or sometimes just TWR. So in summary, the arithmetic return answers the question, what was the average return in a mathematical sense, and measures expected return, not what you truly experienced. Geometric return answers the question, how much did my money actually grow each year on average? And this measures true compounded growth. The time-weighted geometric return, or TWR, answers the question, how well did the investment or the manager perform, independent of when I added or withdrew money. This measures manager skills, not investor timing. And this is the standard for performance reporting under the Global Investment Performance Standards of the CFA Institute. Then you have internal rate of return and answers the question, given when I added or withdrew money, what annual return would make all my cash flows match my ending value? So this measures the investor's money return after considering all the choices he made in terms of topping up or withdrawing from the investments that are beyond the scope of the fund manager. And the IRR is also known as the dollar-weighted return or the money-weighted return. And here's the bottom line. The arithmetic return tells you expected return. Geometric return tells you your wealth through growth. Time-weighted return tells you your manager's skills for comparison with other managers. IRR tells you your personal investor experience. Understanding which return applies to which question protects you from misleading claims and helps you interpret your statements correctly. So don't accept arithmetic returns as a measure of a fund manager's historical performance. Use TWR to compare fund manager's performance and IRR as your personal performance. If your IRR is lower than the fund's time-weighted return, it doesn't mean the fund performed poorly. It may simply mean your cash flow timing wasn't ideal. And if your IRR is higher than the manager's TWR, or time-weighted return, means your timing helped you. These return measures tell different parts of the same story. Using them correctly helps set realistic expectations and keeps you fully informed about how your money is working for you. And I hope this helps clarify these terms for you, and if you enjoyed this video, kindly like and subscribe to continue to support our channel. See you again soon!